The pace of inflation in the United States, as measured by CPI data released this morning, while still elevated, is much lower than the 40-plus year highs of last June. CPI came in at 4%, just under the 4.1% survey, and core CPI, which excludes food and energy, came in at 5.3%, just over the 5.2 survey number. Far better than when CPI hit 40-plus year highs of 9.1% a year ago, but still elevated. Investors are asking, will inflation slow to the Fed's stated 2% target rate? Will the Fed lower rates later this year? Will we enter a recession? Equity and fixed income markets are sending conflicting signals, so maybe we can look to commodities markets for more insight. We'll talk about it today on Open Interest. Hello, everybody, and welcome to Open Interest. I'm Mike Coe. I have a special guest joining me today, Brett Friedman. Brett Friedman is managing partner of Winhall Risk Analytics and an OptionMetrics contributor. He has managed risk for over 30 years and has broad experience working with financial institutions in risk management and operations. He has built and managed 3 risk management organizations, 2 trading startups, and has transacted on numerous exchanges and OTC markets. Brett was formerly the COO and CRO of Brick Accretive Management and an absolute return hedge fund, and he was also the chief risk officer of Ospraie Management, a $5 billion natural resource-based hedge fund and private equity group. He served as a partner at Risk Capital Management, chief risk officer for 3 energy trading firms, worked for 10 years as a futures and options trader, and traded foreign exchange futures and options for the Union Bank of Switzerland. He started his career at the Federal Reserve Bank of New York. Welcome, Brett. It's great to have the opportunity to hear your insights.
Thanks for having me, Matt.
So, when we were talking yesterday, the thing that we were talking about, obviously we are interested in inflation, we are interested in recessions. These are probably the 2 words that matter most to investors right now. And there really has been a stark dichotomy between the signals that are being sent to us by the equity markets and by the fixed income markets. The equity markets obviously have been on quite a tear recently, probably a little bit more sanguine, I think we can say, than the fixed income markets have been, which have been signaling quite strongly and for some time that a recession is imminent. And you have some slides and some insights for us from the commodities markets, and I think that's a great place for us to get started. What are you seeing?
Well, I'm a commodity guy, and I look at the world via what I'm used to, which is commodities. And when I look at commodities, I look at the long-term charts. I look at 2 indices specifically, the Bloomberg Commodity Index, the Goldman Sachs Commodity Index, and both of them, after the Ukraine war, peaked in June 2022. And have been on the defensive since. And as you can see in this chart, it's not like they've been declining minorly. I mean, these are from the wartime peaks. The 2 indices are down 27% almost. Most of these indices are driven largely by energy. In the case of the GSCI, and you can see energy is down significantly from the wartime highs. It's almost unbelievable to think that natural gas is down 76% almost, given that Europe was in a full-blown energy crisis just last fall. Crude is off significantly. It looks like they're having a fairly significant fight with OPEC currently. Agriculturals are down significantly as well, and industrial metals are down. Copper is down, 23% from its wartime highs. As well, you also got implied volatility as measured by the GSG, which is a GSCI ETF, essentially, is also fairly low. So the commodity markets have been steadily declining. They don't have much bounce to them. And as you can see, they have more to go. If you want to say that, the lows were made around, right after COVID, I don't think they're going that low, but it's possible. If you look at this chart, you can see that they're kind of hanging on a cliff here. So when I hear, what's going on with inflation from a commodity point of view, it's, commodities are not bouncing. If you want to blame inflation on something, you can't really point to commodities as being a driver of inflation. As a matter of fact, it's probably it's pointing to the possibility of a recession altogether.
So from your perspective, then, it sounds like the commodity markets are more aligned with the fixed income markets than the equity markets. So if the equity markets might, I think, then by two other markets, perception at least, be whistling past the graveyard here a little bit. Now, one of the interesting things for me is that when people have talked about an economic recovery, one of the hopes I think a lot of people had that we would be able to come out of the long side of the inflation spike and not necessarily have a severe recession was that China's economy could potentially come back to life. And part of that was because, of course, the Chinese economy was shut down much more severely and longer than ours was. And it now is looking a bit as if those hopes might have been a little bit too optimistic. And we can actually, I think, look to commodities a little bit to get some insights on that. You were referencing the industrial metals. When you try to think about how the largest and growing economies in the world are actually doing, what's your preferred measure, and what are you seeing?
I'm seeing basically the same thing. I mean, the party line as of a couple of months ago was that China was going to come out of their post-COVID lockdown and start going back to normal. Our demand would pick up, and you'd start seeing energy, them pulling energy demand, pulling industrial metal demand. As of a couple of weeks ago, it doesn't look like that's happening. Crude continues to go lower. Natural gas continues to go lower. Copper continues to be on the defensive. It doesn't seem like, from the commodity standpoint, it doesn't seem like that demand pull is occurring anytime soon, at least. So I like betting against the consensus. As I said, the party line was that China was going to come out of its torpor. The money was betting against that, essentially, at least in commodities.
Yeah, it's interesting. I mean, when we take a look at policy responses, at least to the extent that they're going to impact commodities like energy, and I guess we can look to oil most specifically when we think about that. If you had tremendous demand pull, it wouldn't be necessary for the Saudis to step in and try to rein in production. And then, of course, the larger dynamic is that they don't necessarily rule the show anyway, right? So even if they cut production and they ask their partners to do the same, what's the reality when they do that?
The reality is that OPEC is a cartel, and like every cartel, the main problem with cartels is that everybody tries to maximize their own income. It's not a cohesive structure. Currently, you have Russia, Venezuela, and Iran cheating and flooding not flooding, but increasing supply, and that's where the supply is coming from. Saudis can talk all they want, but when the Saudis, as a commodity person, whenever I see, or even an equity person, whenever I see somebody blaming short sellers, as one of the OPEC members did, on the current state of the market, it's time to go the other way. They're arguing with the market. There's too much supply, and you got to get, if you're interested in raising prices, go talk to the Iranians, go talk to the Russians, and go talk to the Venezuelans. That's how you increase prices. So not by jawboning it.
Well, I mean, in the case of Venezuela and in the case of Russia, I think that their own populations and their own political issues are probably a stronger driver of basically their production and sales than anybody in Riyadh might be.
Of course.
So, of course, they have to contend with their reality. I think obviously the things you're saying are clear to some of the viewers, but I guess the next question is, what is the actionable takeaway? I mean, my take based on what you're saying is it doesn't make me hugely bullish of equities. Not Now, it is true that equities can rise when we have a recession, but if indeed we have two significant markets signaling a pending recession, generally speaking, you will have a swoon, and it's not until you're well into it that equities will recover. So I realize you are not an equity analyst and an equity strategist, and you tried to point out, despite the fact that I think you studied economics at Columbia, if I read your bio correctly, and you started your career at the Fed. So I'd be putting you a little bit on the spot to ask you questions outside of the commodity space. But there are actually ways to also trade commodities in equity-like products for those that don't actually, for example, trade futures or futures options. And certainly most people who are watching won't be trading the physicals. So I'm curious what you think sort of the best positioning might look like. And then, investors are free to sort of interpret that within the markets where they operate.
There's a couple different ways to play commodities, obviously. Most investors are loath to go, or at least on the retail side, are loath to go via the futures markets. That's obviously the most direct way of doing it. My preferred method for what I would say for most retail investors would to be go into one of the ETFs, such as the one that I just described, the GSG. There's good volume. There's options associated with it, also with good volume. To me, picking stocks that are correlated to, like oil companies are correlated to crude oil, or copper companies are correlated to the underlying commodity. That's certainly true. The problem is that the correlation is high, but it's also variable. So that correlation light occasionally goes off, and you have the commodities going one way, and you have either the equity not reacting or actually going the other way sometimes. So you can be put yourself by trading natural resource-based stocks in relation to the commodities. You could put yourself in the situation where you're right and wrong. You actually had the fundamental right, but you structured the trade incorrectly. And so I would say that if you have a commodity opinion, use the GSG ETF. Personally, I still think commodities are on the defensive. I have no reason to think otherwise. So, and I think implied volatility in the GSG is actually fairly low. It's been trending down since last June, as I said. So I think the commodity, the options on the GSG, especially the puts, I think are reasonably priced. So if you think that, as I do, that they're going to continue to cycle down, I think the puts on the GSG ETF are actually a pretty good deal.
Yeah, it's interesting because you just answered one of the questions I was about to ask you as an options guy, because we are seeing this in equities, that implied volatility is quite low, and people struggle, I think, sometimes to understand the relationship between price and volatility, but they often have a basic understanding or assumption that works a little bit like this. Because they're used to seeing something like the VIX, and they take a look at the VIX's relationship to SPX. And so their understanding is, oh, okay, well, if the markets are generally trending higher, then my expectation would be that the VIX should generally be trading lower. And of course, there is a functional relationship that exists, and that's because upside call options in equity indices will tend to have lower implied volatilities than the downside puts will. Also, steadily rising markets tend to have lower levels of realized volatility. And the principal drivers for volatility for the VIX is going to be the volatility of the SPX, and that's going to be driven by skew and where you are on the surface, and it's going to be driven by realized volatility. Commodities often have functional relationships between volatility and price, but it isn't the same, is it? Because we often will see circumstances where you get call skew instead of put skew in several commodities, especially those where you have shoulder months. I'll think about things like natural gas, for example. So from your perspective, this actually sets up favorably to use options on these commodities to press a bearish bet in declining markets. Is that what you're saying?
Yeah, I mean, I often tell people that if you can trade commodity options, you can trade any option because they're complicated. And you have skew and you have seasonality and you have all these factors intermingling with each other. In crude, what you see generally is volatility, implied volatility increases as prices decline and tends to come off as prices increase until it reaches a certain level. And then you see implied volatility start coming up. To me, when you were talking about what you think the drivers of implied volatility of I remember that, to me, implied volatility is my cost of uncertainty as a market maker. How much is it going to cost me to hedge this position as a market maker? And if the markets are moving incredibly variable, I'm going to increase my implied volatility. I'm going to increase the price of the option to make up for that cost. So to me, as a former market maker, I never really cared about, what level the options are, what level the price level is at. I cared about, all right, I'm selling this option. Now I have to hedge it. And how difficult is that going to be to maintain that hedge over the next couple of weeks? If it's a pain in the neck, I'm going to charge more. If it's not, less. That's to me what's so interesting about the commodity indices coming off with implied volatility coming off means that commodity traders, or at least the index traders, they're not particularly worried about anything. That's what's so strange to me about it. It seems like it's, that you should be worried about this, but it's coming off. And it's like, commodity traders are just kind of, they're just kind of complacent that, since last June, it's coming off steadily. We can hedge this thing. It's not all that big a deal anymore. So that's, to me, what's really interesting about it.
Yeah, to that end, I mean, in the commodity space, when I was trading commodity options, natural gas and oil, one possible explainer for that would be that you have very large market participants, and of course, market makers are going to respond to those institutional flows. So, if you have a lot of producers for whatever reason that are hedging or involving themselves in the market in a mechanism that makes them short vol, that you can depress implied volatilities for that reason. We often would see long-dated options in crude, talking 4 or 5 years out, trading at implied volatilities that would probably seem pretty low to a speculator. But if you thought about it from a producer's point of view, I'm imagining, for example, I remember seeing 3, 4, 5 year 100-strike call options in WTI trading for a dime, but crude was only $26, and the guys who were selling those things thought, I hope to God that was a bad sale, because if it was, then I'm going to be selling crude at $100 a barrel, and I'm going to be sitting pretty. One of the things I noticed in equities in the tech wreck was that there was a regime, you alluded to a regime change, and so I would like to hear your thoughts on this. In the tech bubble, 98, 99, 2000, leading up until March of 2000, the general characteristic that prices would rise and implied volatility would fall held until it didn't. You were making a point about that. And one of the things I've said to people with respect to equities, if you're wondering whether we're getting to a dangerous area, when you begin to see the markets hit new highs, but all of a sudden implied volatility is also rising, and you start seeing individual single stock, idiosyncratic stories where there are big price gaps, that's one of the dynamics that we saw at that time. It was a sign that people were preparing a little bit more for the music stop, that there was just a broader consensus that maybe the party was going to be coming to an end soon, and people started getting a lot more anxious, and we saw options catching a bid. Speak to that in commodities a little bit.
Generally, I can speak specifically. Like a couple of weeks ago, I remember when, gold is suddenly, threatening to make new highs, and for whatever reason won't come off significantly. So it's currently sort of always in danger of shooting past, I think it's like 2030 or something like that is the old high. And when it looked like it was in danger, a couple of weeks, that all-time high was in danger of falling, you saw some action in the $2,100 calls. People were starting to buy them, and because But as a market maker, whenever I hear someone say such and such an option is cheap, what they mean is it's cheap like in dollar terms. Like it's a dime. Who cares? It's a dime. It's cheap. It's 20 cents. You know, it's pocket change. To me, it's like, no, that's not. What do you mean by cheap? Do you mean it's cheap in implied volatility terms? Yes, it's not. It's incredibly expensive versus the at the money. That skew is insane. What you're betting on is a very low probability event, and it's basically a lottery ticket. The lottery tickets aren't fairly priced. So, you know, and what people remember is the one time out of a million that they went in the money. And so, well, you know, I remember when crude went over 100 and people bought $100 calls for 5 cents and stuff. You know, that's a faulty analysis. I'm not playing 1 out of 1,000. I'm trading every single day. You know, that's not what I'm paid to do. I'm not paid to play the lottery. I'm paid to make rational decisions about options. When people start buying out of the money, deep out of the money strikes, what I consider to be crazy prices, and they say it's cheap, that's usually the sign it's time. It's time to start selling this stuff.
Yeah, it's right, that irrational exuberance, I suppose, you know, and I'm borrowing those terms from Alan Greenspan's speech in 1996. Well, this has really been a terrific conversation, and I really hope to have another one with you very soon, because I find your insights to be quite helpful and familiar. You've been in the business longer and in more capacities than I have, so always like to get the viewpoint. So do you have any final thoughts that you'd like to share with folks, Brett, or are we going to save that for the next time?
I think we'll save it for the next time. You know, I was kind of happy today that the CPI number came in lower than expectation, because that's what I was thinking about. You know, that's what the commodities were signaling. Now, whether that's just normal variation in trend, I just happened to get it right, or whatever. But you know, in my view, if you're thinking that inflation is commodity driven, you're wrong. It's as simple as that.
Great, great final thoughts for us. Brett, thank you so much for joining us, and thank you all for watching. We look forward to talking with you guys real soon.